Welcome to Hedge and Haven, your VIP pass to the high-stakes world of billionaires, hedge funds, and global wealth strategies. Today, we're diving into a financial showdown that's shaking the planet. Norway's $1.5 trillion sovereign wealth fund, the Government Pension Fund Global, versus Saudi Arabia's $1 trillion Public Investment Fund, or PIF, in a 2025 wealth war for global dominance. These titans manage trillions, shaping markets, industries, and even geopolitics. Norway's fund, fueled by North Sea oil, owns 1.5% of all global stocks, while Saudi's PIF, backed by Vision 2030, is splashing billions on AI, sports, and mega projects. Who's winning? Is Norway's steady, ethical approach outsmarting Saudi's bold, flashy bets? Or is PIF's aggressive diversification stealing the crown? We're breaking down their strategies, profits, risks, and what this means for you. Whether you're in the USA, UK, Canada, Australia, Germany, France, Norway, Switzerland, or Denmark, from tech stocks to luxury real estate, we'll reveal how to ride this wealth war. Grab your coffee, like, subscribe, and let's jump into the billionaire battlefield. Let's start with Norway's juggernaut, the Government Pension Fund Global, often called the Oil Fund. Valued at $1.74 trillion in early 2025, it's the world's largest sovereign wealth fund per Bloomberg NEF. Born in 1990 to save Norway's oil revenues, it's a model of discipline. With $500,000 per Norwegian citizen, it owns stakes in 9,000 companies, including $2 billion in Apple, $1.8 billion in Microsoft, and $1.5 billion in NVIDIA. In 2024, it posted a record $222 billion profit, a 13% return, driven by tech and biotech gains. Its strategy? Diversified, long-term investing, 71% equities, 27% bonds, 2% real estate. Norway's fund is famously ethical, divesting from coal, tobacco, and firms tied to human rights abuses, like a $500 million pullout from Russian stocks in 2022. It's transparent, with every move public, and capped at 3% annual government withdrawals, ensuring future generations benefit. But it's not perfect. Oil dependency ties it to volatile crude prices, and ESG focus can limit returns. Still, Norway's fund is a global benchmark, influencing pension funds from Oslo to Ontario. Now meet Saudi Arabia's Public Investment Fund, the $1 trillion wildcard. Launched in 1971, but supercharged under Crown Prince Mohammed bin Salman's Vision 2030, PIF is Saudi's tool to diversify from oil, which still accounts for 40% of GDP. In 2024, PIF's assets hit $925 billion per global SWF, with a $36.8 billion profit after a $15.6 billion loss in 2022. Its playbook: high-risk, high-reward bets. PIF owns 4% of Saudi Aramco, worth $80 billion, and has splashed $3.5 billion on Uber, $2 billion on Nintendo, and $1 billion on sports streaming DAZN in 2025. It's big on mega projects: $500 billion Neom City, $200 billion Red Sea Resorts. Unlike Norway's global spread, 70% of PIF's investments are domestic, boosting Saudi's economy. But it's less transparent, governed by MBS, not public oversight. Risks? Over-reliance on oil revenues and flashy bets like $40 billion in AI could flop. Yet PIF's bold moves make it a global power, rivaling Norway's cautious empire. Let's compare their investment strategies. Norway's fund is a passive giant, spreading $1.5 trillion across 70 countries, with 71% in equities like $1 billion in Nestlé and $800 million in Amazon. Its real estate portfolio includes $500 million in London's Regent Street and $300 million in San Francisco offices. It uses AI-driven algos to track ESG compliance, divesting $200 million from firms like Adani Group in 2024 for environmental violations. Saudi's PIF, meanwhile, is an active deal maker. It's poured $100 billion into electronics, $40 billion into AI funds, and $10 billion into U.S. real estate, like Miami's $200 million condos. PIF's sports investments, $5 billion in Saudi Pro League clubs like Al Nassr, draw stars like Ronaldo, boosting global brand value. Norway prioritizes stability with 27% in bonds yielding 4.5%. PIF chases growth with 20% in private equity, like $2 billion in Blackstone. Norway's low-risk approach averages 6.3% returns since 1998. PIF's 8% over 5 years comes with volatility. The global impact of these funds is massive. Norway's fund, owning 1.5% of global stocks, stabilizes markets. Its $10 billion stake in S&P 500 firms like Alphabet steadies tech indices. In 2024, it boosted Norway's GDP by 10% per Norges Bank, funding pensions and healthcare. Its ethical stance pressures firms. $1 billion divested from coal pushed renewable stocks up 15%. Saudi's PIF, though, reshapes industries. Its $40 billion AI fund, targeting chips and robotics, challenges U.S. dominance. NEOM's $500 billion budget creates 1 million jobs, per Vision 2030, but critics call it a vanity project. PIF's $10 billion in European football, including Newcastle United, shifts sports economics. Geopolitically, Norway's fund is neutral, while PIF's tied to MBS's agenda, raising sports washing concerns. Both funds influence global capital flows, but Norway's transparency wins trust, while PIF's opacity fuels skepticism. What about profits and performance? Norway's fund earned $222 billion in 2024, a 13% return per Reuters, driven by tech rallies. Apple's 24% gain added $500 million. Its diversified portfolio weathered 2022's market crash, losing only 5% versus S&P 500's 18%. PIF's $36.8 billion profit in 2024 was solid, but its $15.6 billion 2022 loss exposed risks. PIF's Aramco stake gained $20 billion, but sports bets like $300 million on Kylian Mbappé flopped. Norway's 6.3% annualized return since 1998 beats PIF's 8% over 5 years when adjusted for volatility. Norway's bond-heavy mix cushions downturns. PIF's private equity bets, like $5 billion in Lucid Motors, swing wildly. For investors, Norway's stability is a safe bet, while PIF's growth appeals to risk-takers. In 2025, Norway's tech focus could outshine PIF's oil-tied gains if crude dips below $80 per barrel. Risks are a big factor. Norway's fund faces oil price volatility. Brent crude at $90 in 2025 supports inflows, but a $60 drop could cut $50 billion yearly. Its ESG focus skips high-yield sectors like tobacco, costing $1 billion annually per Norges Bank. Currency risk is real. A 10% stronger krone shaved $100 billion in 2024. PIF's risks are bolder. Its $500 billion NEOM project, only 10% complete, faces delays and $20 billion cost overruns, per Bloomberg. Political risk looms. MBS's control invites sanctions if Saudi's human rights record worsens. PIF's 70% domestic focus ties it to Saudi's economy, vulnerable to oil shocks. Both funds face global headwinds: 3.5% inflation, $300 trillion global debt, and Biden's 2025 tax pact targeting wealth funds. Norway's transparency mitigates scrutiny. PIF's opacity invites it. How do they stack up in 2025's trends? Tech is king. Norway's $10 billion in NVIDIA and $5 billion in Tesla align with AI and EV booms. PIF's $40 billion AI fund and $2 billion in chip makers like TSMC chase the same trend, but risk overexposure. Real estate is hot. Norway's $500 million in London offices yields 5%. PIF's $200 million Miami condos target 8%. Crypto's a wild card. Norway avoids Bitcoin, while PIF's $1 billion in crypto platforms bets on 120,000 Bitcoin. Geopolitics shape both. Norway's neutral stance dodges U.S.-China tariffs, while PIF's $10 billion in U.S. assets faces Trump's 25% levies. Luxury markets thrive, Norway's $1 billion in LVMH and PIF's $200 million in Saudi resorts cater to the 1%. Norway's ESG push aligns with Europe's $2 trillion green funds. PIF's oil routes clash with net zero goals. What can retail investors learn? Mimic Norway's diversification. 5 to 10% in ETFs like SPDR, S&P 500, SPY, up 20% in 2024, or iShares MSCI World, URTH. For UK, Germany, Vanguard FTSE All World, VWRL, tracks Norway's global bets. Canada's TFSAs or Australia's super funds can hold SPY tax-free. Chase PIF's growth with private equity ETFs like Invesco Global Listed Private Equity, PSP, up 15%. Norway's real estate play, try iShares Global REIT, REET, yielding 4%. PIF's AI bet, Global X Robotics and AI, up 22%. Norway's $5 billion bond holdings suggest iShares Core U.S. Aggregate Bond, AGG, for stability. Risks, overweighting AI or crypto could crash 25%. Keep 10% cash, like Norway's $50 billion liquidity. Denmark's ATP or Norway's pensions show the way. 5% in REITs, 10% in tech. History offers lessons. Norway's funds survived 2008's 23% loss, recovering $200 billion by 2010 per Norges Bank. PIF's $100 billion loss in 2016's oil crash forced a $50 billion Aramco stake sale. Both learned resilience. Norway's 27% bonds cushioned 2022. PIF's $35 billion COVID-era stock bets gained $14 billion. Retail investors don't chase hype. Allocate 10% to trends like AI. Hold for 12 months. Norway's patience and PIF's boldness balance risk-reward. In 2025, global debt and tariffs threaten, but diversified funds thrive. Norway's $1 billion in green bonds and PIF's $10 billion in renewables show sustainability pays. The 2025 outlook is fierce. Norway's fund could hit $2 trillion by 2027 per UBS if tech rallies hold. PIF aims for $2 trillion by 2030, banking on $100 billion in Aramco dividends. Norway's ESG focus wins Europe's $3 trillion pension funds. PIF's sports and AI bets draw Asia's $1 trillion investors. Risks: Trump's tariffs could cut PIF's $10 billion profits by 20%. Norway's krone strength could trim $50 billion. Luxury safe, $200 million chalets in Norway, $80 million jets in Saudi. Who wins? Norway's stability or PIF's ambition? Comment your pick. Like, subscribe, and hit the bell for more billionaire battles, hedge fund hacks, and wealth strategies. Hedge and Haven's your edge. Stay sharp, stay wealthy.